Good afternoon, ladies and gentlemen, and thank you for joining us here today for our OIC webinar presentation on weeklies, monthlies, and LEAPS. My name is Ken Keating, and I'm a senior instructor here at the OIC. I've been involved in options trading and analysis for well over 25 years, and currently I work at the OIC helping individual investors such as yourselves to better understand the risks and benefits of exchange-traded options. So just to give you a little background on myself, I started out as a market maker on the floor of the Pacific Coast Stock Exchange in the early 90s. I then moved to Chicago, where I traded on the Chicago Board of Options Exchange, both as a floor market maker and a floor specialist. I migrated off floor, where I ran some prop desks as well as risk management desks. I traded for myself as a sole proprietor for many years, and I also spent many years as an equity and derivatives analyst studying equity and option flows for publicly traded companies. So that's enough about me. Just wanted to, a couple things we have to get out of the way, just house cleaning. As you have seen our presentations before, you're probably very familiar with the disclaimer. So options involve risks and are not suitable for everyone. Individuals should read and understand the risk disclosure documents, characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org or through your broker, or you can actually shoot us an email at options@theocc.com, and we would be happy to send you one free of charge. In order to simplify today's examples, commissions, fees, margin interest, and taxes have been not included. And lastly, any strategies discussed here today, including price data and securities, are strictly for illustrative and educational purposes and should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities on behalf of the OIC. So a little bit about the OIC. So who is the OIC? Well, we are the Options Industry Council. We are the education arm of the OCC, which is the Options Clearing Corporation. The Options Clearing Corporation is the world's largest equity options clearinghouse and the foundation for secure markets in the U.S. So we are the leader in free and unbiased professional options education. Everyone says, well, how do you do it for free? What's the catch? Well, actually, there is no catch. We are fully funded by our parent company, the OCC, so we have no agenda other than to offer you best-in-class options education. We do that primarily through our website, optionseducation.org. There you'll find online courses, podcasts, videos, and webinars. We're actually in the process of revamping our learning management system, so sometime later in 2020, you will see a completely new website. We're actually revamping our content. We're going to have a more comprehensive and robust options curriculum. And we're also bringing back the options simulator, which many of you have been asking about. So a lot of exciting things to come later in the year. The pride and joy of the OIC is our investor services desk, which can be reached at options@theocc.com with any and all of your options-related questions. You can reach us there Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time, and we are certainly happy to help. So this is a quick look at the annual options volume from the inception. Options began trading in 1973 on the Chicago Board of Options Exchange. They started out on 16 different issues, and I believe on the very first day they traded 928 contracts. Contrast that today, where typically on average we trade around anywhere from 16 to 20 million contracts a day. Although with the unprecedented volatility that everyone's been witnessing in the market, volumes have been considerably higher. In fact, we broke 3 volume records in February alone. In February, we averaged just shy of 30 million contracts a day. And March as well is averaging currently around 32 million contracts a day. So certainly more and more individuals using options to hedge and position themselves amidst this tremendous volatility we've been witnessing lately. All right, so here are the U.S. listed options exchanges. These are the 5 main parent exchanges. There's the BOX, the CBOE, MIAX Options, NASDAQ, and NYSE. These are the exchanges where your orders are routed to and executed at, where you buy and sell your options. These 5 main parent companies own and operate 16 different sub-exchanges. We're not going to get into the differences between the sub-exchanges, just know that they do exist, and they have different execution platforms. All right, here is our presentation outline. So we are going to start our presentation with a little bit about pricing. Specifically, we're going to get into the Greeks and what the Greeks are, and then more importantly, how the Greeks impact the weeklies, the monthlies, and the LEAPS. Then we will start getting into a description of the weeklies. We will be talking about the monthlies throughout the presentation. And lastly, we will finish with a discussion on the LEAPS. So Q&A will be conducted along the way. My colleagues Mark Benzaquin and Bill Ryan are actually behind the scenes answering your questions real time. There is actually a tab at the bottom of your screen that you can pop out for Q&A. Just to answer probably one of the most popular questions we get, can I view this webinar after the event? And the quick answer is yes. So since you've registered for this event, you will receive a link sometime in the next 24 hours that'll give you access to this very presentation if you want to revisit it or for whatever reason you missed part of it. You can also click on the menu at the bottom of the screen under the resources list, and you can pop that out and you can download a copy. You click the presentation button and you can download a copy of the PDF if you'd like a PDF of the PowerPoint presentation for your records as well. All right, so why options? Why do people trade options? Well, options actually give you options, to coin a really bad pun. So options offer you flexibility. So if you were presented with buying or selling a stock, there's only 2 things you can do with stock. You can buy stock if you're bullish, or you can sell stock if you're bearish. Options, on the other hand, allow you to put on multiple strategies that you can put on if you are bullish. There are multiple strategies that you can put on if you're bearish, as well as multiple strategies you can put on if you think the market is actually just going to be quiet and not move around a lot, which lately that hasn't been the case. It's been very volatile, but certainly options give you flexibility. Many investors choose to use options for risk reduction through the use of protective puts, purchasing protective puts on their individual stocks and portfolios, as well as one of the more popular strategies, writing call options against their holdings, either at the money or out of the money calls to generate a little more income. And also investors will use options through the use of cash secured puts to also create income, but to establish a price that they are willing to get long the stock should the market pull back. So certainly a lot of strategies that you can incorporate, a lot more flexibility using options. All right, so let's get into the Greeks. So for many of you, this is just going to be a review. And if you're not familiar with the Greeks, this is actually going to be quite informative. So these are the Greeks. They are what affect option prices, okay? And there's 5 Greeks. There's delta, gamma, theta, vega, and rho. And the obvious difference between weeklies, monthlies, and LEAPS is the time component, how much time to expiration we have. The least obvious difference in the weeklies, monthlies, and LEAPS is how the Greeks affect them. So depending on which options you're trading, the Greeks affect the weeklies, monthlies, and LEAPS in different ways. And we're going to get into that a little later, but just keep that in mind. So delta is the option's expected change in a change in the underlying stock price. In other words, how much my option makes or loses money with every dollar move in the stock. So it's usually expressed as a decimal or percentage, but how much my option makes or loses when the stock goes up or down $1. Gamma, on the other hand, is the expected change in an option delta with changes in the underlying stock price. So a good way to think about gamma is gamma is the speed of your option, or the speed of your delta, how many added deltas I pick up if the stock rallies, or how many added deltas I lose if the stock goes south in the case of calls. Theta, on the other hand, theta is the expected change in an option's value with the passage of time, so also known as time decay. So when you buy or sell options, those options have a finite life. There's an expiration date. So as we get closer and closer to expiration, those options decay at a more rapid rate. So if we are option buyers, that theta or time decay is working against us. And if we are option sellers, that theta is actually working for us. So depending on whether you're long or short options, theta can either be your friend or your foe. Vega is the expected change in an option's value with a change in implied volatility. Now, Vega is the most misunderstood aspect of options pricing. And if you're trading options, I really recommend that you understand implied volatility and volatility in itself, because this is such a crucial aspect of options pricing. Now, we're not going to get into a long talk. I could speak for hours on implied volatility, but just know that it is a crucial aspect of options pricing. Typically, if you have an options position and the stock is not really moving, but all of a sudden you're making or losing a lot of money and you can't figure out why that is, usually more often than not, it's because implied volatility is either going up or down. And it's usually that Vega number that's impacting you. So rho is the option's expected change in value with a change in the risk-free interest rate. So while rho is important to understand, it's probably the most impactful of all the Greeks. So I remember when I was trading options and I had a huge book, and I had delta, I had all these Greeks for my individual stocks, and then I had Greeks for all my entire book. And yes, I had a number for rho, and yes, it did impact me if interest rates went up or went down, but it didn't really dictate whether I was bullish or bearish. While it does impact your options, it's really not one of those Greeks that's going to dictate whether you put on an options position or not. All right, so the nature of the Greeks. The Greeks are only meaningful during an option's lifetime. So what does that mean? So when that option gets to expiration, okay, it's either in the money or out of the money. In other words, it's either stock or it's not. So at expiration, all the time value in that option expires. So it only really impacts an option while the option still has time value left in it. So the idea that there's the idea also that Greeks' values will affect other Greeks as well. So perfect example of this is what we've been seeing lately in the market, with implied volatility going through the roof and the market having these big down days and implied volatility going up, meaning option prices are expanding. What that means is that implied volatility goes up, your theta will expand, the amount of money that those options decay every single day. And why is that? That's because as those options get more and more expensive with implied volatility going up, your theta every day goes up. In other words, how much that option will decay in value. Another thing to keep in mind is implied volatility goes up and theta goes up, deltas for options will tend to move closer to 50. Obviously, the 50 delta options, the at-the-money options, will stay roughly at 50, but the more in-the-money options will gravitate closer to 50, and the out-of-the-money options will gravitate towards 50 as well. So in the case of like a call options, if you have a $50 stock, the 50 calls and puts are right at the money, but maybe your 40 delta call, which is deep in the money, might have a delta of 95, might go down to 90 if implied volatility goes up. Likewise, if your out-of-the-money call, that's a 20 delta, might go to 25 if implied volatility goes up. So simply when implied volatility goes up, what the market is trying to tell you is that your options have a higher likelihood of being in the money. So, and thus the deltas move towards 50. So the impacts of Greeks differ for each option contract, whether it's in the money, at the money, or out of the money, and as well as near term and far term. So one thing to keep in mind is implied volatility certainly has a greater impact on the longer dated options, in other words, the LEAPS, while theta, or time decay, has a greater impact on the weeklies and monthlies, so especially the weeklies. So the weeklies will decay faster than the monthlies, which will decay faster than the LEAPS. So once again, theta impacting the weeklies more so than the LEAPS, and implied volatility, changes in implied volatility affecting the LEAPS more than the near terms and the monthlies. All right, so now let's take a little deeper dive into the Greeks. So delta, once again, is the options sensitivity to changes in a stock price. So how much my option makes or loses with a $1 move in the underlying. So let's take an example of a $50 call. Let's assume we're along a $50 call for $2 and it's right at the money. Stock's at 50. So that 50 call has roughly a 50 delta. So what that means is if the stock goes up by $1, all things being equal, our option should be worth about $2.50. Likewise, on the downside, if our stock went from $50 to $49.50, our option, all things being equal, would now be worth about $1.50. So it's how much our option changes with a $1 move in the stock, either up or down. So stock itself has what's called 100 delta. So if you're long stock, say we're long 100 shares of XYZ, and XYZ goes up $1, that we're going to make $1. And likewise, if XYZ goes down $1, we're going to lose $1. So stock is considered to have 100 delta. Okay, and all options have deltas. It's just how many deltas they have. In the money, options have higher deltas than at the money, which are generally about 50, and out of the money, deltas have less deltas because, of course, they're out of the money. Gamma is the delta's sensitivity to a change in stock price. So in other words, as I mentioned earlier, the speed of your options, how many added deltas I pick up with a $1 change in the stock price. So once again, using the example of the 50 calls with the stock at 50, if our stock goes up by $1, we're going to no longer have a 50 delta option. We might have, if our gamma was 2, now if the stock at 51, our option would have a delta 52 rather than 50. The decimal here, it says that 0.002, that's probably the gamma for a long-term option. So if we were trading a 30-day option, our gamma would be, maybe 2 or 3, and for every dollar move up, our calls would gain 3 deltas, and for every dollar move down, our calls would lose 3 deltas. So it's the speed of our option. Lastly, only options have gamma. Stocks do not. All right, here's a look at gamma versus time. So one thing to keep in mind, as expiration nears, the gamma of the at-the-money calls increases, okay, and the gamma for the in-the-money and the out-of-the-money calls decreases. So why is that? So once again, it's that idea that if we're approaching expiration and say we're a couple days before expiration and our stock goes from 45 to 50, and now we're maybe long or short the 50 calls or the 50 puts. Well, the gamma on that option goes up because, once again, at expiration, that option is either going to be 100 delta or it's going to be 0 delta. It's either going to be in the money or out of the money. And because that stock goes right to strike, the gamma goes up for that option as we approach expiration. And as you can see that on the chart, we took a $60 strike, or a $60 strike at a 30 vol, and you can see the gamma for the 1 week option is a lot higher than the gamma for the 1 month option, which in turn is higher than the gamma for the 3 month option, which is higher than the gamma for the 6 month option. So once again, that idea that as we get closer and closer to expiration and if our options are at the money, the gamma does increase. Theta is the options value sensitivity to a change in in time. So once again, options have a finite life. Every day that passes that stock or our index doesn't do anything, the option will be worth less and less. So this is expressed in decimal form. So in this example, we have theta of 0.08. So in our example with the 50 calls that we paid $2 for, all things being equal, if we had, if the stock opens up tomorrow and it's still at 50, it doesn't do anything, we can safely assume that the option that we paid $2 for today, tomorrow is probably going to be worth about $1.92. Okay, it's going to be worth 8 cents less. So it's how much that option decays in value as with the passage of every single day. So it represents a cash amount per option, and granted, all other pricing factors being held constant. We're not considering if implied volatility is going up or down, changes in interest rates or dividends, anything else, just everything else being held constant. So both calls and puts have negative theta amounts if we are long options. So once again, that idea that long option holders, theta is working against you. But if we are short options, our theta number is positive. So that number is money that's going into our pocket. Our options that we're short are worth less and less with every passing day that the stock really doesn't do anything. Okay, here's a chart on time decay. So time decay is not constant. So those options don't lose, like the previous slide, don't lose 8 cents every day until expiration. Okay, as you can see here, the chart we have, the top line is a look at the at-the-money options, and the lower line, the flat line, is more in-the-money options. So as you can see, the 90-day options 3 months from now, they do decay, but not as rapidly as the 60-day options, and certainly not as rapidly as the 30-day options. So once you get into that 30 days, you see that the slope of that line really start to get steeper. Well, what that's showing you is that exponential time decay. So generally, option sellers like to target anywhere from 30 to 45 days as the sweet spot where they like to capture premium and take advantage of that faster and faster decay. So that's what you're seeing is the slope of that line getting steeper and steeper as the options get closer and closer to expiration. In the money options, on the other hand, the line is more flat because in the money options are mostly comprised of intrinsic value. Okay, so if we have a 40 level strike and our stock is trading 50 and our call is going to have an intrinsic value of $10. So it might have a time premium in it of maybe 20 cents. So only time premium decays, not intrinsic value. So once again, showing that in the money options don't decay. They decay more linearly, just more in a flat line only because there's not as much time premium, where at the money options are entirely based on time premium and will suffer the most time decay in a quiet market. All right, so that's enough for the Greeks. So now let's get into talk on the weeklies. So the weeklies were essentially introduced in 2005 to give investors certainly more targeted trading opportunities around binary events, earnings events, Fed announcements, FDA announcements. So they didn't necessarily have to pay out for a 3-month option or a 1-month option. They could it was more targeted. So it gave investors a lot more flexibility, a lot more to basically put on their options, their forecasts, and their ideas. So currently they're available on approximately 15% of listings, and they're generally listed on a Thursday with a Friday expiration, and they can be up to 5 or more weeks away. Typically, the weeklies are not listed if a normal monthly expiration happens during that week. So in other words, this week we have monthly options that expire this Friday on March 20th. So this week, if you were trading a stock that had a weeklies, you wouldn't see a weekly option. So in other words, the weeklies don't double up with the monthly. So if the monthly exists, it's only going to be the monthly, but then there'll be weeklies around the monthly if that stock does have weeklies that trade. So some weeklies have various expiration days, so not necessarily just Friday. Some have Monday, Wednesday, and Friday expirations, and these are usually ETF and or indexes. And some weekly options can have different contract specifications other than their monthly counterparts, such as AM or PM settlement, which we'll get into in a little bit. But you really have to be careful when you're trading weeklies and know exactly when your expiration date is and whether your contract is an AM or a PM settled option. So investor interest in weeklies have certainly picked up. I remember when they first were listed in 2005, they really didn't trade that much. But today, weeklies are comprised, you can usually count on about 20 to 30% of average daily volume to comprise of the weeklies. So recently, when we've been doing roughly about 30 million contracts on any given day, 6 to 9 million of those contracts will be comprised of the weeklies. If you'd like a list of all the available weeklies, you can certainly visit our website, the OCC website, and do a query under the series and trading data section, and there you'll be able to download an Excel spreadsheet that will give you all the products that are available that have weeklies on them. Also, weeklies do exist for some index products and some equity products. Once again, it's around 15% of the products that trade. That breaks down to around 600 to 700 products in all. So they're not available on all products, but certainly they're usually the more household names, the products that trade more. And certainly investors will like to use index options as well that will alleviate the risk of early assignment because they're European. Depending on the index, they can be European style exercise, which can only be exercised at expiration. So once again, certainly know the specs of the contracts that you are trading. So weekly options will settle in the same manner as standard options based on the same underlying index or equity. So once again, there are going to be a large majority of the weeklies are PM settled and expire on Friday, but some options do have AM settlement. So you really have to be careful of which type of settlement your option has. So AM settlement certainly adds certain overnight risk in the underlying before the settlement price is known. So perfect example of this is regular SPX options. The last trading day for those would be the Thursday before the Friday that the settlement price comes out. So you might be short SPX options that expired 20 points out of the money, some call options. And you figure, well, I'm not going to buy them back because I've got no risk. Well, the settlement price isn't actually known until the following morning. So what happens in especially the SPX is the following Friday morning, they do a settlement price for those options. And what they do is they take the opening price of every component of the S&P 500, and they take a snapshot, comprise a settlement value. That's where your options settle at. So if all of a sudden some bullish news came out Thursday night to Friday morning, we get a trade deal with China, they have a coronavirus vaccine that comes out, and all of a sudden the futures are up 100 handles. Well, what was once out of the money by 20 points could now be deeply in the money. So once again, really understand the risks associated with AM settlement options, especially if you're short them. Equity and ETF options are generally PM settled, so that will allow you for trading up to the close of that expiration. So, if you're trading a PM settled weekly or a PM settled regular option, once again, know that you can trade that option up until the close of expiration of that trading day. And lastly, the only way to really alleviate a short option position and not have that assignment risk or that overnight risk is to purchase back a short option. Many times the out-of-the-money options in the SPX will be trading at what appears to be really dumb prices, but the reason why they're trading at those inflated prices, even on expiration, even on the last day that they trade, is because there's that overnight risk in those options. So just keep that in mind. All right, here are the theoretical issues generally about weeklies. So buyers are attracted to the relative low cost for hedging and establishing positions. So because we're focusing on 1, 2, maybe 3 weeks of time premium, we're not paying as much in time premium for those options, but at the same time, we're subjecting ourselves to a greater amount of decay. So, near-term options can be okay for buyers, but you have to get your forecast right. You have to be spot on your direction because you have a limited amount of time. Sellers, on the other hand, are attracted to the fact that options in the near term have that more rapid time decay. Once again, options under 30 days to expiration generally start decaying at a more rapid rate than the regular monthly options, which certainly sellers of options are attracted to. Also, keep in mind that idea that as your options, as we get closer and closer to expiration, if those options become at-the-money options, your gamma goes up. So once again, those Greeks kicking in, and the idea that once the gamma kicks in for that option, whether you're long or short, as we get closer and closer to expiration, that option can be stock or it's not. So you have that gamma risk, especially if you're short gamma, if a stock's right at strike as we approach expiration. Okay, here's just another visual look at decay and how the near terms expire a little harder. So what we're looking at is the fictitious stock. We priced it at $21 out of 50 volatility. So what we're going to look at the 21 calls, the at-the-money calls at various expirations. So at 22 days to expiration, the calls, the at-the-money calls are roughly worth about 75 cents. So 7 days later, if the stock doesn't do anything, 15 days to expiration, our 21 calls are going to now be worth 61 cents. So we've lost 14 cents in time value. Then, if for another 7 days passes and the stock doesn't do anything, our options at 15 days, which are worth 61 cents, are now going to be worth 43 cents. So now we've lost 18 cents in value. So once again, that time decay picking up and getting greater as we approach expiration. And then finally, with 7 days to go, we get to 1 day to expiration. Our option goes from 43 cents down to 19 cents. Now our option has decayed 24 cents. So you can see that 14 cents, 18 cents, 24 cents. As we get closer and closer to expiration, that decay getting greater and greater. All right, so just a few guidelines. Weekly options generally see most of their volume in the near-term expiration. That is unless, of course, there is another week that might have a corporate action or maybe an earnings event. So certainly if you're trading weeklies, be aware of dividends and certainly earnings announcements. As most of the volume is in the first week to expiration, you will see equal amounts of decay both for the calls and the puts due to put-call parity. So, once again, investors like targeting those weeklies for the added decay that they offer. But once again, with selling near-term options, there's also that added risk. So something to keep in mind. Weekly options take advantage of the faster time decay, but also reduce the time for the investor to adjust their gamma risk. Going back to the idea that the gamma for the at-the-money calls goes up as we get closer and closer to expiration. And a short call strike can quickly turn into a short stock price, and a short put strike can quickly turn into a long stock obligation if not treated properly. All right, this is one of my favorite charts. This is we're going to talk a little bit about options skew. What exactly is skew? Well, skew is essentially the difference in implied volatility between the out-of-the-money calls and the out-of-the-money puts. And generally speaking, the out-of-the-money puts are relatively more expensive than the out-of-the-money calls. And why is this? Well, prior to 1987, there wasn't a lot of skew priced into the options market. And then, as you all remember, in 1987, October of 87, we had the crash and stocks lost roughly 23% of their value. And all of a sudden, traders woke up to the fact that, oh my God, stocks can and do go down harder than they go up. And because that they go down faster and harder than they go up, there's this natural pricing skew for the downside. So there's an old saying in the market that the market goes up on foot and the market goes down in an elevator. And certainly that's something we've all witnessed in the last 3 weeks, as I'm sure all of you can attest to. And when you think about it, it makes perfect sense because generally most people in the market are just long the market, whether they're long stocks, mutual funds, commodities, oil, whatever, you name it. Most people are just long the market. So the only way to hedge themselves would be to either, without, other than just selling out their holdings, is to either buy puts and or sell calls. So when investors buy puts to protect their portfolios, they bid up the price of those puts, and when they're selling out-of-the-money calls to create a little income, they're depressing the out-of-the-money put price. So you've got this give and take between, you got this demand for puts that's pushing up the downside for the out-of-the-money puts, and you've got this supply side that's pushing down the price of the out-of-the-money calls. And that's what you're seeing on this chart here, is this natural skew. So if you look at 21, we're assuming that 21, the stock is right at strike. So it's comparing the 1 week options to the 1 month options. As you can see, both lines are steep to the downside. That's just showing you that those out-of-the-money puts are more expensive than the out-of-the-money calls, but the weekly slope is a lot steeper. If we had superimposed monthly options and leaps on this, you would have lines below the month, and the slopes you'd still see that skew. It just wouldn't be as steep as the near term. So this is also known as vertical skew, and certainly skew is affected by sentiment and supply and demand relationships. So, with implied volatility going through the roof lately and the market making these huge down moves, option prices across the board are very expensive. So when the option prices get expensive, the skew gets expensive. And the skew is what's pricing in the fear or the gap risk of a particular index or a stock. So once again, the downside generally being more expensive than the upside. All right, so that's enough on skew. Now we're going to talk a little bit about the LEAPS. So what exactly are LEAPS? Well, LEAPS stand for Long-Term Equity Anticipation Securities. And simply put, that's just a long-winded way of saying these are just longer-dated options. So these are options that are anywhere from 9 months to up to 2.5 years away. Currently, we have the Jan 2021 LEAPS and Jan 2022 LEAPS. The Jan 2023 LEAPS will be added this year on September 14th, Monday, September 14th of 2020. And the new LEAPS are always added in September, expiration week, usually the Monday before expiration. And so if anybody was curious when the 2023 LEAPS will be added, that'll be Monday, September 14th of this year. When an option goes from being a LEAP, a 1-year option, to 9 months or less, it simply just becomes a regular option. So as investors, there's nothing you need to do when this change happens. This is more of a back office technical issue, but just know that your options, the contracts and the specs, everything about that option, nothing changes. It just converts to a regular option. It's no longer considered a LEAP, but everything else stays the same. So, and once again, LEAPS, investors love using LEAPS because a lot of people will use them for stock substitutes, because you're not paying as much for those for the LEAPS as you are for the stock. And certainly any of the strategies that you can incorporate around stock you can use with LEAPS in terms of calendar spreads or vertical spreads or diagonal spreads or butterflies, condors, you name it. So certainly many different strategies that you can incorporate using LEAPS. All right, so LEAPS, once again, go out about as far as 28 months. The Jan 2022 LEAPS are nearly 700 days away. They're actually around 675 days away as of today. They're available on roughly a third of the available stocks, so not all stocks have LEAPS. Usually these are the more popular names, and once again, the stocks that trade more that have the LEAPS. When you're looking at LEAPS, you're certainly not going to have as many strike choices in the LEAPS as you will for the weeklies or the regular monthlies. And you'll also see, you'll tend to see some of the pricing on the LEAPS tends to be a little wider just because LEAPS are really hard to price. And I can tell you that personally as an ex-professional trader. There's a lot of moving parts to LEAPS, which we will get into, but they are very hard to price. So the exchanges determine which LEAPS or which strikes will be added. So if a stock moves, generally, the exchanges do a pretty good job of keeping up with which strikes are added. We get plenty of requests on our desk for strike requests. Honestly, more often than not, the exchanges are more than happy to list an option strike, and unless it's really egregious and way far away, very rarely have I seen a strike request turned down. So just keep in mind, it's not the OCC that determines which strikes get listed. It is the exchanges themselves, but they are actually very accommodating in terms of accommodating requests. Okay, a little bit about LEAPS pricing. The same thing that affects LEAP pricing is the same inputs that affect regular options and weeklies. So once again, for our option model, we need to have the stock price, the strike price, the time to expiration, volatility, dividends, and the interest rate. So it's the same inputs, but changes in the inputs have a different impact on the price of LEAPS. So primarily speaking, volatility, dividends, and interest rates are a bigger factor in terms of pricing the LEAPS. Once again, that idea that implied volatility, changes in implied volatility affecting the LEAPS more than the monthlies and the weeklies. And this makes perfect sense because the LEAPS have more time premium in them. Okay, you're buying or selling a greater amount of time, so changes in implied volatility are going to affect that to a greater degree. Once again, also because of the extended amount of time, changes in interest rates will have a greater effect on a longer-term option, as will changes in a dividend stream. So if all of a sudden a dividend goes up by 25 cents over the next 8 dividend periods, that's certainly going to change the pricing on a LEAP. All right, so once again, we're going to talk about time decay. Time decay is not linear. Those LEAPS options, certainly they do decay, but they don't decay quite as fast as the monthly options, regular monthlies, and they don't decay as fast as the weeklies. So the weeklies decay faster than the monthlies, and the monthlies decay faster than the LEAPS. The LEAPS do decay, but at a lesser rate than the monthlies and the near terms. Sometimes buying a little more time does not necessarily cost you that much more. So an option that's trading that's 30 days to expiration that costs you $1, the 1-year option that expires 12 months from now isn't necessarily going to cost you $12. That option might cost $4 or $5. So sometimes buying a little more time does not necessarily cost you that much more. And also there are times that buying the front month or selling the front month does make sense. But also remember, the near term with the reduced cost comes accelerated time decay if you're a buyer. And certainly in the near term, if you're short options, a huge move can certainly cost you if you like to short those near-term options as well. Okay, so this is just a visual of, once again, the time decay. Just looking at the LEAPS, yes, they do decay, but not as quickly as the the monthlies or the weeklies. As you can see all the way down to the lower right-hand corner, you see once we get to around 30 days or 1 month to expiration, that the slope of that line gets steeper. Once again, just showing that exponential time decay as we get closer and closer to expiration. All right, so let's take a look at some what-if scenarios. What we're going to do is we're going to compare a 3-month option versus the Jan 2022 LEAP. So what we did is we took a 50 strike call with a stock price trading 50, so the at-the-money call. We modeled it at a 30 volatility where we assume current interest rates and no dividend, just to keep things simple. So when we put all that into our option calculator, our 3-month option is worth $3.06, and our LEAP is worth $8.93. So if the stock doesn't do anything for a month, okay, our 50 call a month later is now going to be worth $2.49. So we've lost 19% on that 3-month option. Our LEAP is also going to lose a little value, but it's only going to lose 2% and be worth $8.72. So once again, that time decay working harder against the 3-month option than the LEAP. 2 months later, our LEAP is going to be worth $1.75, 30% less. And then 3 months later, with the stock right at 50, theoretically our 50 strike call is worthless, and we would have a loss of $3.06, an entire 100% loss on our investment. Our LEAP, on the other hand, would lose an additional 2.5% and still be worth $8.31. So yes, we'll lose money on our LEAP, but we still have all that time on our side to make up for it. Stock rallies, we certainly have time to make up some of that time decay that we gave up in the near term. All right, so what happens if we're right? Well, let's say our stock rallies to 53.25. Well, now our 3-month option is looking like the better choice. Our 3-month option would be worth $5.09, a return of 66%. Our LEAP will also make money. It'll be worth $11 with the stock trading 53.25, a gain of 23%. So we're making money on both options, but clearly you can see the 3-month option outperforming percentage-wise than the LEAP, and that's because of that delta and gamma effect for the near-term option. So because the gamma is higher on the near-term option, we're actually accelerating, we're actually making more money on a near-term move on the 3-month option versus the LEAP. So then let's assume that the stock just sits at 53.25 for the next 3 months. Well, a month later, our 3-month option is going to be worth $4.55, so still not a bad return of 49%. Our LEAP is going to be worth $10.79. We're still going to be up 21% on that option, but as you can see, our options time decay now starting to kick in on that 3-month option. So all the way down to 3 months later, where yes, we still have a return on our 3-month option. It's worth $3.25. It's only increased in value by 6%. But now our Jan 2022 LEAP is worth $10.37, or a return of 16%. So now if the stock just sat over the next 3 months, our LEAP would actually outperform. So time decay working against us on the 3-month option, certainly not as much of a factor for the Jan 2022 LEAP. Okay, and lastly, what happens if we're wrong? Well, if we're wrong and the stock goes from $50 to $47.50, we lose $2.50 on the stock. Our 3-month option is going to be worth $1.88. We're going to lose 39%. Our LEAP is also going to lose value, but that's only going to lose 17%. It's going to be worth $7.45. 1 month later, if it just sits at $47.50, our LEAP is going to be worth $1.36, so we're going to lose 56%. I'm sorry, not our LEAP, our 3-month option. Our LEAP is going to be worth $7.25. It's going to be worth 19% less, and so on and so forth. So all the way at expiration, 3 months later, our 3-month option obviously is worthless with the stock trading 47.50. But our LEAP, while it has lost 23% in value, it's still worth $6.85, and we have all that time on our side to possibly experience a rally in the stock. Maybe the stock rallies and we get some of that back, maybe we revisit it and look to time spread near-term option against these LEAPS or calendar, or maybe do a vertical spread or turn it into some other strategy. But certainly we still have plenty of value left in the Jan 2022 LEAPS. All right, so now we're going to take a look at LEAPS pricing. So how will interest rates and or dividends change the value of the LEAPS over the next 2 years? So an increase in interest rates are going to decrease put premiums, and they're going to increase call premiums. And why is that? Okay, well, there's a very good reason why that is. So pricing models take into consideration the cost of capital used to offset risk. So if I'm a trader and I buy puts, more likely than not, I'm going to buy stock to hedge myself. Well, at the same time, if I sell calls, I'm going to have to buy stock to hedge myself. So the cost of my hedge goes up with interest rates rising. So for me as a trader, to compensate for that increased hedge cost, I have to pay less for my puts and sell my calls for more if interest rates go up. Okay, so once again, interest rates being incorporated into the option pricing model. So dividends, on the other hand, work just the opposite way. So an increase in dividends will decrease call premiums, and they will increase put premiums. And why is this? Well, essentially, if we have our stock, say we have our $50 stock that we talked about earlier, and let's say tomorrow it goes ex-dividend for 50 cents. Well, all things being equal, we can assume that our stock that's trading 50 today, tomorrow is going to open up at 49.5. Okay, we're not going to be out any money because we're getting our 50-cent dividend, but now our stock is trading 50 cents lower. Well, an increase in dividends is going to have to be factored into our pricing model. So if the dividends go up, put premiums will have to go up, and call premiums will have to go down to compensate for that increase in dividends. Because once again, calls can only be if you want to capture the dividend, you're not going to get a dividend by owning calls. You would have to exercise your calls to capture a dividend. And in order to exercise your call for a dividend, you would be foregoing any time premium left in that option. So for longer dated options, you would never exercise your calls for a dividend. It just wouldn't make sense. But just know that an increase in dividends would increase put premiums and decrease call premiums. And likewise, a decrease in dividends would decrease put premiums and increase call premiums. All right, well, once again, knowing the Greeks and having a basic understanding of the Greeks at least will give you a little leg up in understanding the difference between weeklies, monthlies, and LEAPS. So just in summary, once again, the weeklies certainly more impacted by that greater amount of theta, okay, time decay working against those weekly options to a greater extent than the monthlies or the LEAPS. And once again, that gamma risk is that as the options become more at the money for the weeklies, the gamma for those options increases, whether you're long or short them, okay? LEAPS, on the other hand, certainly more impacted by changes in implied volatility. So with implied volatility going up, like we've been witnessing lately, obviously, 3 weeks ago would have been a good time to actually purchase LEAPS because you would have benefited, especially LEAP puts, because you would have benefited from a downside move in the market, plus the added benefit of implied volatility going up. So kind of a, double whammy. But certainly implied volatility affecting those LEAPS more so than the monthlies or the weeklies. And lastly, interest rates and dividends having more of an impact on the LEAPS just due to the fact that LEAPS have more time and there's a lot more, in terms of a dividend stream, there's more dividends that can be paid, and interest rates certainly that cost of carry affecting the LEAPS to a greater degree than the monthlies or the weeklies. All right, so that's our presentation I just want to thank everyone for joining us here today. We really appreciate your support of our webinar series. I invite you to visit us at optionseducation.org for more information regarding options and anything to do with options. You can certainly reach out to our investor services desk at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. And certainly check us out on our YouTube channel where we have archived many of our past webinars and also included additional web content and video content related to everything options. So if there's a subject that you want to learn more about, implied volatility, condors, time spreads, you name it, I can guarantee you we've done multiple videos on these, and you'll certainly benefit by checking those out. Please check out our OIC YouTube channel as well. So that is our last event. Today is our last event for March. Our next event will be April 8th, where our own Alan Ellman, president of the Blue Collar Investor, will be taking us on a deeper dive into covered calls. So you'll certainly want to show up for that. And once again, I thank you for your time today, and we look forward to seeing you at our next event. Thank you very much.